Imagine waking up tomorrow morning, grabbing your wallet, and heading out to run a few simple errands. Maybe you stop for groceries. Maybe you need to pick up a prescription. Maybe you're meeting a friend for lunch. You pull out your debit card, swipe it like you've done thousands of times before, and suddenly the screen flashes a message you never expected to see. Transaction declined. Confused, you try again. Declined. You check your bank balance on your phone and discover the money is still there. Every dollar is exactly where it should be. Yet somehow, you can't access it. Your account has been restricted, your transactions are blocked, and nobody warned you this was about to happen. As unbelievable as it sounds, this exact situation is becoming increasingly common across America, especially among older account holders. And the most alarming part is that in many cases, there was no fraud, no mistake by the customer, and no missing money. A computer system simply decided that something about the transaction looked unusual and automatically raised a red flag. Over the past few years, banks have dramatically changed the way they monitor customer accounts. Behind the scenes, powerful artificial intelligence systems now analyze nearly every financial move people make. These systems watch spending habits, login patterns, transfer activity, withdrawal amounts, payment recipients, and dozens of other details that most customers never even think about. The goal sounds reasonable enough. Financial institutions are under tremendous pressure to stop fraud, scams, and financial exploitation before money disappears. Criminals are becoming more sophisticated every year, and older Americans remain one of the biggest targets. Regulators, consumer protection agencies, and law enforcement organizations have pushed banks to become more aggressive in identifying suspicious behavior before losses occur. The problem is that these systems don't always know the difference between a scam and a perfectly legitimate transaction. Sometimes they see risk where none exists, and when that happens, innocent customers can suddenly find themselves locked out of their own money. What surprises many people is how personal these monitoring systems have become. Your bank isn't just looking at individual transactions anymore. It has spent years building a profile of your financial habits. It knows approximately when your paycheck or retirement income arrives. It knows the stores where you typically shop. It knows the amount you usually spend on groceries, fuel, utilities, and entertainment. It knows the devices you normally use to log into online banking. It even understands the patterns of your daily financial behavior. The moment something falls outside those patterns, the system begins asking questions. A larger than normal withdrawal, a transfer to someone you've never paid before, a login from a different device, or an unusual spending spike can all trigger additional scrutiny. Sometimes that scrutiny is invisible. Other times it results in delays, transaction denials, or temporary account restrictions that leave customers scrambling for answers. One of the fastest growing triggers involves digital payment platforms. More people than ever are using instant payment services to send money to family members, friends, contractors, caregivers, and businesses. Unfortunately, criminals are using those same platforms to target victims, which means banks have become extremely sensitive to transactions involving unfamiliar recipients. If you suddenly attempt to send a large amount of money to someone who has never received funds from you before, the system may assume you're being manipulated by a scammer. It doesn't matter if the payment is completely legitimate. It could be money for a family member, assistance for a friend, or payment for a service you've already agreed to purchase. The algorithm cannot see the context behind the transaction. It only sees activity that appears different from your historical behavior. In many cases, that alone is enough to trigger intervention. Large cash withdrawals have also become a major source of account reviews. Many customers are surprised when bank employees begin asking questions about how they plan to use their own money. Years ago, requesting several $1,000s in cash might have been routine. Today, tellers are trained to pay close attention whenever a customer requests a withdrawal that appears unusual. This isn't necessarily because the bank suspects wrongdoing. In many cases, employees are trying to identify signs that a customer may be under pressure from a scammer, fraudster, or financial predator. Unfortunately, this means legitimate transactions sometimes receive the same scrutiny as suspicious ones. Customers who are simply paying for home repairs, purchasing a vehicle, helping a family member, or handling personal expenses may suddenly find themselves answering questions they never expected to hear inside their local branch. Another area where many people unknowingly create problems involves transaction reporting thresholds. There is a common misconception that keeping transactions below certain dollar amounts helps avoid attention. In reality, attempting to break a large transaction into multiple smaller transactions can sometimes create far more concern than simply completing the transaction normally. Financial monitoring systems are specifically designed to detect patterns that appear structured or intentionally divided. What seems like a harmless effort to avoid paperwork can actually trigger reviews that would never have occurred if the transaction had been completed in a straightforward manner. This misunderstanding continues to create unnecessary complications for countless customers every year. Perhaps one of the most overlooked risks involves accounts that sit untouched for long periods of time. Many people maintain emergency savings accounts, certificates of deposit, or backup accounts that they rarely use. They assume that because the account remains open and continues earning interest, everything is functioning normally. What they don't realize is that inactivity rules have become much stricter in recent years. Simply allowing interest payments or automatic transactions to occur may not always count as meaningful account activity. Financial institutions increasingly want evidence that the account owner remains actively engaged with the account. Without that engagement, dormant account procedures can eventually begin, creating headaches that many people never see coming until they receive an unexpected notice or discover their funds have become significantly more difficult to access. There is also a powerful legal tool that many Americans have never heard of, despite the fact that it can temporarily prevent access to their money. Under financial protection laws designed to combat elder fraud and financial exploitation, banks may have the authority to delay or restrict certain transactions when they believe a customer could be at risk. These measures were created with good intentions. They are designed to stop criminals before life savings disappear forever. However, they can also create frustration for legitimate customers who suddenly discover that a transaction they intended to complete immediately is now subject to review. During these situations, customers often learn that frontline employees have very limited authority to override the process. Even managers may be unable to remove restrictions until the review is complete. One of the most effective tools available to reduce these disruptions is something surprisingly simple: establishing a trusted contact. Many people mistakenly assume that adding a trusted contact gives someone access to their money. It does not. A trusted contact is simply a person the bank can reach if concerns arise about unusual account activity. When suspicious behavior triggers an alert, having a trusted contact available may allow concerns to be resolved much faster than if the institution has no one to verify the legitimacy of a transaction. In many situations, a quick confirmation call can prevent days or even weeks of unnecessary complications. Despite this benefit, millions of customers have never taken the few minutes required to set one up. There are several practical steps every account holder should consider taking immediately. If you know a large transaction is coming, contact your bank beforehand and let them know what to expect. If you maintain multiple accounts, log into them regularly instead of letting them sit untouched for years. If you plan to send money to a new recipient, understand that unusual transfers receive more attention than ever before. Most importantly, avoid keeping all of your available funds at a single institution. Having access to a secondary account elsewhere can provide an important financial lifeline if one account becomes temporarily restricted while a review takes place. The reality is that banking in 2026 looks very different than it did even a few years ago. Artificial intelligence now watches accounts around the clock, searching for signs of fraud before customers even realize a threat exists. While these systems are helping prevent billions of dollars in losses, they are also creating unexpected challenges for ordinary people who simply want access to their own money. Understanding how these systems work, what behaviors attract attention, and how to prepare for potential issues can make the difference between a minor inconvenience and a financial nightmare. The customers who avoid problems are rarely the ones with the most money or the most sophisticated accounts. They are the ones who understand the rules before those rules affect them. And in today's banking environment, that knowledge may be more valuable than ever. But the story doesn't end there, because one of the biggest mistakes people make is assuming that if they've never had a problem with their bank before, they'll never have one in the future. That's exactly what thousands of account holders thought right up until the moment they found themselves spending hours on the phone trying to regain access to their money. The banking system of today is not the banking system many seniors grew up with. Years ago, a local branch manager might have known your name, recognized your face, and understood your financial habits personally. If something unusual happened, there was often a human being making a judgment call based on years of experience with your account. Today, many of those decisions happen long before a human ever sees your file. They're being made by automated systems that process millions of transactions every day and are programmed to prioritize caution above convenience. From the bank's perspective, accidentally delaying a legitimate transaction is considered less risky than allowing a fraudulent one to go through. Unfortunately, that means honest customers often bear the burden of proving their transactions are legitimate. One area where this is becoming increasingly common involves online banking access itself. Imagine you're visiting family in another state. You pull out your phone to check your balance or transfer money, and suddenly you're locked out of your account. The system notices that you're logging in from a location you've never visited before. Maybe you're using a new phone. Maybe you're connected to hotel Wi-Fi. Maybe you're traveling internationally. Any one of those factors can trigger security protocols designed to protect your account. While these protections are important, they can create serious problems if you're relying on that account while away from home. This is why many financial experts now recommend notifying your bank before extended travel, just as people once notified credit card companies before taking vacations. A simple notification can prevent an automated system from interpreting your perfectly normal travel activity as a potential security threat. Another growing issue involves joint accounts, particularly among older couples and family members. Many people assume that because two names appear on an account, both individuals will always have unrestricted access. However, if suspicious activity is detected, restrictions can sometimes affect the entire account, regardless of which person initiated the transaction. Imagine a situation where one family member unknowingly clicks a suspicious link, responds to a scam message, or attempts an unusual transfer. Suddenly, both account holders could find themselves dealing with additional verification procedures. This is why communication between joint account holders has become more important than ever. Everyone connected to the account should understand basic fraud prevention practices, because one person's actions can affect everyone else associated with the account. Then there are the phone calls. If you've noticed more fraud alerts, security texts, and verification requests from your bank lately, you're not imagining things. Financial institutions are contacting customers more frequently than ever before. The challenge is that scammers know this. They have become experts at impersonating banks, creating convincing messages, and generating a sense of urgency that causes people to act before thinking. A customer receives a text claiming their account has been compromised. They receive a phone call minutes later from someone claiming to be from the fraud department. The caller sounds professional. They know the customer's name. They may even know which bank the customer uses. Before long, the victim is providing information that allows criminals to gain access to the very account they believe they are protecting. This is why one rule has become absolutely critical in today's financial environment. Never trust an incoming call, text, or email that claims to be from your bank, no matter how convincing it sounds. If you receive a message that concerns you, hang up the phone, ignore the link, and contact your bank directly using the number printed on the back of your debit card or listed on the institution's official website. This simple habit has prevented countless fraud losses. Criminals thrive on panic and urgency. The moment you slow down and verify information independently, you take away their greatest advantage. Let's also talk about beneficiaries, because this is another area where many people unintentionally create major problems for their families. Millions of Americans assume that having a will automatically determines who receives money held in bank accounts. In reality, many financial accounts follow beneficiary designations that may override instructions contained elsewhere. If beneficiary information is outdated, incomplete, or missing entirely, loved ones may face unnecessary delays and legal complications after an account holder passes away. Financial professionals routinely encounter situations where accounts have not been reviewed in decades. Marriages, divorces, births, deaths, and family changes occur, yet beneficiary records remain untouched. Taking a few minutes to review these designations can spare family members months of frustration later. Another important development involves identity verification requirements. Banks are increasingly asking customers to provide updated identification documents, contact information, and personal details. Some people become suspicious when these requests arrive, assuming they are scams. In many cases, however, the bank is simply complying with federal regulations that require institutions to maintain accurate customer records. The danger comes when customers ignore legitimate requests for too long. Eventually, outdated information can create delays when access to the account is needed most. Keeping your contact information current ensures that fraud alerts, security notices, and verification requests actually reach you before a minor issue becomes a major problem. Perhaps the most valuable lesson in all of this is understanding that prevention is far easier than resolution. Once an account is frozen, restricted, or under review, there is often very little you can do to speed up the process. Phone calls, complaints, and frustration rarely override security protocols. The best strategy is to avoid triggering unnecessary reviews in the first place. Stay in regular contact with your financial institutions, keep account information updated, notify the bank before major transactions, review beneficiary records periodically, establish trusted contacts, maintain access to more than one financial account. These steps may seem small, but together they create a powerful layer of protection against the disruptions that are becoming increasingly common in modern banking. The bottom line is simple. Banks are not monitoring accounts the way they did 10 or 20 years ago. Artificial intelligence, fraud prevention systems, elder protection laws, and heightened security measures have transformed the financial landscape. While these changes are designed to protect customers, they can also catch honest people completely off guard. The more you understand how the system works, the less likely you are to become one of those customers standing at a checkout counter, staring at a declined transaction, wondering why you suddenly can't access your own money. Knowledge is no longer just helpful in today's banking world. It's becoming one of the most important financial protections you can have.